As you probably know by now, the Federal Reserve has decided to cut interest rates yet again. Markets initially sold off on this news because the Federal Reserve indicated that next year, during 2025, they would only cut rates 2 more times. The reason they gave for lowering rates only 2 more times is because they acknowledged a complete failure to rein in inflation.
Once again, we've had a year-end projection for inflation, and it's kind of fallen apart as we've approached the end of the year.
And despite all of that, despite the fact that inflation is higher than their expectations, despite the fact that they failed to get inflation down to their target, they are still lowering rates at the end of 2024 into this higher inflation and still plan to lower rates further in 2025 in the face of this higher inflation. The question is why? You'll find the answer in looking at the Federal Reserve's other mandate. One of their mandates given to them by Congress is stable prices. They try and control prices through their interest rate and balance sheet policy by expanding or contracting the money supply. Lowering rates into higher inflation means that they are ignoring the stable prices part of their mandate and defaulting to the other mandate instead. And despite the fact that Powell said this was about employment, it is not about employment. Here, I am referring to the Fed's third mandate given to them by Congress, which comes after maximum employment, stable prices, and it is moderate long-term interest rates. Many people are not aware of this, but the Fed's dual mandate, given to them by Congress, does not have 2 mandates. It actually has 3. And the third one is to make sure that long-term interest rates are moderate, whatever that means. So why in the world would moderate long-term interest rates be the thing that the Federal Reserve is worried about right now? And you might think that sounds completely preposterous considering the fact that long-term rates have actually risen as a result of recent market action and monetary policy. Don't worry, I'm going to break it all down for you here. The Federal Reserve has these 3 jobs for one purpose only, and that is to ensure that the federal government survives financially. The mandate of maximum employment ensures that the federal government constantly has a growing supply of wage slaves to continue to tax. Employees pay most of the taxes to the federal government, so maximum employment means that they have the maximum possible tax base. So the Federal Reserve's job number 1 is to make sure the federal government has the largest tax base possible. The mandate number 2, which is stable prices, is interpreted as inflation at 2%, which is growing prices. Given the fact that the government always borrows more and more money as time goes on, means that the government is able to take advantage of inflation by borrowing dollars that are worth less than the dollars they have to pay back. Further than that, making sure that inflation continues at least 2% per year means asset prices continue to go up. As prices go up, wages go up. This means that not only is the tax base growing from maximum employment, but asset prices and the actual dollar amount that people are earning from those wages goes up over time as well, which means the government can take a larger and larger amount from taxes as a result of inflation. And the third mandate that the Federal Reserve has, which is moderate long-term interest rates, means the government can continue to borrow more and more debt and not have to worry about those interest rates getting too expensive for them to afford. So as you can see, all 3 of the jobs given to the Federal Reserve by the government are there to ensure that the government can continue to get the money that it needs to spend regardless of financial circumstances and regardless of its own financial health. So what in the world does that have to do with them lowering rates today in light of inflation? Well, it all comes down to this chart. We're going to break down this chart that we're looking at here, but basically this is the amount of dollars the US government has to pay in just the interest expense on the national debt. Now this is stated as a percentage of total tax income. You can see this peaked in about 1985 through about 1995 at around 20%. This means during that time, every single dollar that the United States government was getting in taxes, they were having to take 20 cents of that and spend it on the interest on the national debt. That was about double where it's been for the last 2 decades or so, and it was about triple where it was for a few decades before that. But recently, this number has begun to climb and is projected by the CBO, the Congressional Budget Office, to skyrocket from here. Right now, most of the federal government's debt is at relatively low interest rates. But over the past couple of years, because the Fed has been fighting inflation and raising interest rates, the government has been rolling over its debt at higher and higher interest rates, which means they are paying a larger and larger amount for just the interest on the debt. That is why on this chart you see this has spiked so severely recently. In dollar terms, the US government is spending about $1.2 to $1.5 trillion per year just on the interest on the debt. To put that into perspective, it is almost the entire deficit, meaning almost the entire amount the government is borrowing in between the amount it makes in taxes and the amount that it spends on top of that. Almost the entire deficit just goes to paying the interest on the debt. Powell himself has stated in the past that this path is unsustainable. Eventually, it spirals out of control. But here's the kicker. The longer interest rates stay high, the faster this interest expense grows. And that is because most of the federal government's debt is actually weighted towards the short end of the curve. Almost a third of the US government's debt matures in under 2 years, which means the government is constantly borrowing new debt just to pay off that old debt that they just borrowed a year or two earlier, which means the most powerful way to help the government's finances is to change the interest rate at the short end of the curve, which is where the Federal Reserve controls interest rates. So the Federal Reserve is looking at the choices right now of either continuing to fight inflation and bring it down to its target and risk the federal government not being able to afford its bills, in other words, default, or start to lower rates to allow some ease in the federal government rolling over its debt, paying a little bit less in interest expenses along the way, and hope that inflation just doesn't run out of control as a result. This is directly a part of the long-term debt cycle that I've been warning you guys about for quite some time now. I've been telling you to expect higher interest rates for yourself, lower interest rates for the government, and as a result, higher inflation for everybody else. And that is exactly what we are seeing play out before our very eyes. Because anytime a government gets to the point where its debt to GDP ratio is around 120%, it either has to just accept defeat and collapse, or it has to do a deleveraging. And usually governments choose to do that in an inflationary way. This means they control the printing press in order to pay off the debt and unload the pain of that deleveraging onto the economy through higher prices. And so the real reason the Federal Reserve is lowering interest rates despite the fact that inflation is above their target and by all measures looking to increase from here is because they're bailing out the federal government. That's what they're there for. That's what their mandate tells them they must do. And until their mandate is either rewritten or the Federal Reserve itself is ended, that is what they will continue to do. So expect higher prices and higher interest rates for the foreseeable future. As always, thank you so much for watching. Have a great day.